Hello and welcome to this month's edition of the Unio Market Update. My name is Gerald Fitzgerald and I'm joined today by my colleague Alex Kinsella. Alex, how are you?
I'm good, Gerald. Thanks. Good to see you.
Thanks very much. Good to see you too. Jumping straight in, equity markets continue to perform positively over the year to date. Looking at underneath the bonnet, however, it seems that it's the IT sector actually that's generating a significant proportion of the headline returns.
Yeah, absolutely. So, technology has been the real story this year. It's up over 30% year to date, Gerald, at this stage, significantly ahead of the broader market, which is up about 10%. So, if you look back last year, it was a bit of a laggard and there was that cyclical rotation, but that's absolutely turned around and we've seen technology roaring ahead. Now, there are certain pockets within technology that have been really delivering a lot of this return. And if I just look at this slide here of NVIDIA, so this is in the AI space, which we're all familiar with now with ChatGPT and Bard. And you can see it's up over 180% year to date, I think, at this stage about that. And what we have seen is we've seen really significant improvements in its earnings and also in its future earnings potential as well. So it's been beating analyst expectations, and that's really pushing this price up. So it's captured a lot of attention from investors, both retail and institutional. So it's going to be really interesting to see how that plays out over the remainder of the year and kind of continue on this growth path in what's a really interesting sector. Now, it's not the only interesting sector in the market. I think if I just jump to this page, we've got the financial market has been one that we've been focusing on a lot so far this year, Ger.
Absolutely. And if we're looking at the, I suppose, returns on financials versus headline global equities in red and financials in purple, or US financials in purple, you can see that, I suppose, broadly speaking, they were running somewhat in parallel up to the end of 2022, and the start of this year and up to the year to date has seen that divergence between global equities and US financials, and that is driven primarily on the back of the banking concerns that we have seen, the likes of SVB. Now, if you're looking at the subsector of US financials and looking at, in particular, those US regional banks, you can see that the return profile here in orange points to, I suppose, a larger negative return. And even looking back where we've come from over recent years with central bank rate rises and those being the tailwind for those banks, we can see that there's quite an unwind of that position coming through now, and those banks being back at near 2020 levels. Speaking of central bank policy and in particular the US Federal Reserve, from a yield curve perspective, we can see that the market perception or expectation here of the cost of US borrowing is going through a period of flux. And if we're looking at in 1 year's time, from 2024 to 2028, the market expectations are going to be are currently that the US Federal Reserve is estimated to cut rates, or is perceived to cut rates by nearly 1.5%. And I suppose that is a significant, I suppose, reversal of trend that we have seen in recent times. And that market pricing, if you look back at the likes of the global financial crisis in 2007, we certainly are at a more polarized level compared to periods of time like that. So really, there's a lot to play out here. Looking across to, I suppose, the month ahead, now we spoke about the banking system, and if we think about I suppose, what we've had over the course of the year to date, and that depositor flight to, I suppose, the larger banks or I suppose non-deposit facilities through money market funds or otherwise, I suppose that confidence and that sentiment by I suppose those deposit holders, it points to the fact that they haven't returned. That capital flight has not gone back into those regional banks, and really, I suppose, it asks the question that sentiment about a systemic risk seems to continue despite reassurance, despite the FDIC stepping in. So ask the question as to whether this has fully played out just yet. Looking across the Pacific, China, over the start of this year, we would have seen China perform particularly well, but more recently, I suppose, the CCP's efforts to, I suppose, agitate a lagging and a stalling property market, it hasn't materialized to the I suppose, anticipated levels that they would have hoped for. That, I suppose, compounded by a significantly high youth unemployment rate, and I suppose some more material economic indicators which have been disappointing of late point to an economy that is, I suppose, stuttering to get back to the momentum that we would have seen over the last number of years. Alex, I can't believe we actually have got through so many slides without even mentioning the US debt ceiling at this point in time.
Yeah, absolutely. You know, it was certainly a story over the last couple of months that we were focusing on, and actually the market was focusing on as well, as we, you know, veered towards the potential for a historic US default. Thankfully, last weekend you saw Biden and McCarthy, the House Speaker, reach an agreement that had to be voted on then this week, which the Republican Party did, and it passed. So it was really good news for markets, and that pushed markets forward about 1.7%. On foot of that. So I think it paves the way also for maybe more of a bipartisan kind of structure between now and the election next year. So I think it was a really good win for Democrats in particular, but also for markets in general to see that extension without us reaching the slippery slope of a default. There are other aspects as well, though, that we're focusing on, not just in the month ahead, but actually the months ahead. So that geopolitical risk, you know, if I allude back to China that you mentioned earlier, Ger, the US and Chinese relationship is obviously very fraught. And that is particularly been played out in that regulatory aspect. So while we saw Q1 Chinese economic data looked really strong, didn't manifest in good market returns. And a lot of that was due to regulatory risks that the US is applying, where it's making it more and more difficult to invest in that market as a Western investor. So geopolitical risk is certainly there, and it's going to be a factor as this deglobalization period comes to an end. We're even seeing that in the form of a hot war in Europe between Russia and Ukraine. So, you know, what that other impact from this is inflation risks, and inflation, we're all familiar with that at this stage. So how that's going to taper, which we're seeing at the moment, is tapering down, how that plays out, that's going to bring us full circle and all the way back to that yield curve that you mentioned, you know, and how that may delay or how it may allow the central banks to move towards that rate reducing potential, which, as you pointed out, is looking at the end of this year, which is in line, which is where they see the potential for a recession emerging in the US. Certainly they're aiming for a soft landing. That's where the money is pointed towards at the moment. And it's certainly going to be an area of interest for the next while to watch this play out. So I think that draws us to a close, Ger. I think we're going to have a lot to watch over the next month, and we look forward to having a chat next month. Yeah,
absolutely. Listen, thanks very much for your time, and thank you all for joining in. Thank you. Bye-bye.